Welcome, everybody, to the Chinchilla Pickin' Podcast. It is January 15th, 2023 at 2:52 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am joined by Brandon Beaver. Brandon, how are you, sir?
Oh, I'm great, man. Hey, guess what? You were down on the whole, sports betting thing. I
I,
put I put $1 down and I bet on every single game Friday night in the NBA, hit on every one of them. $77. But you know what? And you know what? I will say this. It was a $77 bet because you always say take your money and run. By the time I think it was 8 out of the 10 of the NBA games had already hit, it gave me the option to cash out for like $38. I took it.
nice.
Could have
That's a
made
safe bet,
77, but $1 turned into 38.
right? That's smart, man. Look at you, man. Yeah, I will never promote gambling as a way to make money. And I will never promote it as sports entertainment
You know what
either.
it is? It's not really a way to make money. It's just a way to have fun. And it's only if you don't take it too far, you know? And it kind of like the only thing that's similar in sports betting and stocks is that you never want to use more than you can lose. That's it. And then you just like it's play money. Like if you decide not to go out, on a date on a Friday night or something like that, or if you decide not to go out and do something for fun, you take the money that you would use for fun and bet, and that's it. Just have fun with it. It's fun money. It's not supposed to be something that makes you $1,000,000.
Right, right. So there you go, man. I don't know. I even as sports entertainment, like you're saying, entertainment purposes, still big no for me. That's a no for me, dog.
Yeah.
No, sorry, I'm not gonna do that. I will say, guys, I know you guys are so interested in my workout routine and diet and all that, guys, but I'm going to share it with you anyways because this is our show. I am down 15 pounds so far, whoop, whoop, and going strong. I got a good group of people that are joining me that we work together and we help each other, and I'm feeling good about it. I feel like my skin feels better. I've been eating healthier, drinking more water, and it's been all around great. So I'm losing weight. My income goes up, continues to go up. I am 6 feet tall. So if there's anybody out there that would like to date me, not you, Brandon, sorry. Feel free to reach out. I'm joking. I'm joking. But yes, I'm losing weight. F45 training, guys. I enjoy it. I love it. Find it in your local area, and do it. What do you say we get some financial and investment stuff, huh?
What's
You want
that?
to talk about that? I know, right? What is that? Who talks about stocks?
What I thought it was
Um,
a betting podcast.
all right,
Come on,
so
Bills. Keep the lead.
rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. You actually hear the live discussion back and forth here on the show. Brandon agreed to let me go first with one topic and one topic only, and then he'll take it over from there. So I get to talk about this topic, and it's something I talked about previously last year. I've mentioned this a couple times last year, and the way I was mentioning is we were talking about what kind of dominoes would have to start falling in order for us to see the U.S. economy sinking, and that's the context sort of what this came up as, and I brought up the Apple credit card. And I said that the Apple credit card has been put out there to a large amount of subprime users have an Apple credit card. I said the only good thing about going for it is Goldman Sachs is backing it up financially. Now, the Apple credit card did not come out. It came out during COVID. It came out right before COVID. The end I think it was Q4 of 2019 is when it actually came out, and it was only to Apple people and so on and so forth. So it came out during COVID. Everybody had their stimulus checks. Everybody was getting all these other bonus checks and different things coming in. You could switch jobs and move up and get your income higher. And people were getting Apple credit cards. And I said, with the high subprime usage of this card, if I start to see this card fail, I would think that the economy would be on a domino effect to happen next. Now, having said that, do I believe that this card is failing? No, I don't believe it's failing, but it's not looking good. So let me give you some numbers, Brandon, before I give you a chance. I'm going to give you some numbers, then I'm going to let you talk, and then I'm going to give you some more numbers. Cool?
Yeah.
All right. So some of the numbers I'm going to give you. Looking back from 2020 through the end of September 2022, the losses of the Apple credit card was $3 billion. That's a loss. That's a net loss of the Apple credit card was $3 billion in net losses. But when Q4 results of 2022 were included, it's been expected it's going to rise to $4 billion. Hasn't been announced yet, but the expectation is going to jump up to $4 billion. That's a $1 billion loss in the Q4 of 2022. This was what I was afraid of. We're going to start seeing mountain losses and people just say, you know what? I'm not going to pay that off. I'm going to dump this card and just not use it because I can't afford it. That is a scary situation, I believe, for a brand new credit card. It's only been out since 2019 and it's high subprime usage. Thoughts on just that basic information?
No, it's just surprising to me that a company like Apple would be dealing with this. Now, granted, it's more on Goldman Sachs being the financer of it, but still.
Well, here's the thing is, and now that you say that, right? So let me give you some more information, is that Apple is saying that they can turn this around and they can make this card profitable or at least break even by 2025. Now, Goldman Sachs is they're kind of hesitant to give Apple more money for this, which they shouldn't have to because Apple should have plenty of money on hand. But it's an agreement they have with Goldman Sachs back and forth. Goldman Sachs is a little hesitant to give them more money in order to make that happen, which is what they need to do. And they need to pump in a few billion in order to turn this and make it possibly break even by 2025, which is what Apple says they can do. But Goldman Sachs is reluctant to give them that money. So they might have to restructure the agreement where Apple uses their own money.
I'd be hesitant too, at least through this year. Not knowing what kind of recession we face. I think it's a win, not if, and it's a how deep, not if question. And not knowing those things, I would be hesitant as well.
And for me, it's a surprise. It's not it's not surprising in that I was thinking that this might happen last fall. If you listen to our show and you're a continued listener, if you listen to our show last fall, I said that this might happen, right? That where it's going to continue to get worse for Apple and their credit card. We talked about this. So it's not surprising, but what's surprising to me is that a company like Apple is having trouble with a credit card. And it's because they push it on subprime users, people who just don't have the credit score for this type of credit card, in order to build a base of users. Anybody that had certain Apple subscriptions or Apple products was, pretty much guaranteed that, like the basic was at $400 credit limits on a basic credit card for low credit score. And so they're just racking up the debt and they're just slow to pay it off, or they're not paying it off at all. And this is a problem when we try, Brandon, I don't mean to cut you off here, but I'm going to continue. Let me make this last point. This is a problem when we try to give loans or finances to people who haven't figured out how to correctly budget and actually get their finances in order.
Yeah. Well, here's the thing. Like, how many people have you met that don't have jobs, don't have any form of income, may or may not be on welfare, maybe even a couple kids, whatever, but yet they still got the latest and greatest iPhone because they want to keep up with the Joneses.
All right, yeah.
You offer a credit card to people that are subprime that really can't afford an iPhone, but they almost see it like kind of as a free iPhone. That's what it is to them. Like, they're not going to pay it down. It was, not a good idea to go subprime on it. He gets a $1,200 device.
and that's what most people are using it for, is to purchase their Apple devices and pay for their Apple subscriptions and yada yada yada. And yeah, this need for Americans to I don't want to be preachy, So I'll make this real quick, but the need for Americans to go ahead and have the latest and greatest is ridiculous. But besides that, I think that this is a bad move for Apple, and they're going to have to find a way to pump in the money. They have the cash on hand to save this credit card. The question is, are they going to save it? Are they going to pump in the cash to save it? Is this where they want to go, or are they going to say this is a loss and move on from here?
You push down the break even on it of as far as the timeline goes. Push that back. Increase the credit limit that's needed. That's the long-term way of doing it. And you know what really sucks about it is the fact that if you're increasing the credit limit on it and you're not going subprime, then there's going to be even less customers, especially this year if we go into a recession, because more people are going to have their credit ratings go down. But I still think that's the best way to go about it, just to improve the default rating.
Yeah, I see what you're saying. Improve the default rating, but yes, and I agree with you. There are going to be fewer prime consumers out there who can get those loans quickly by the end of the year because of the recession. But we'll get into that later because we're going to talk about banks and everything, and I have a lot of information on that. But yeah, as far as Apple goes, this is not a good situation for them, and it's not failed. So I said if it failed, that would start the tumbling of the U.S. economy, first domino to fall, but it has not failed yet. It's just not producing a profit, but it had $1 billion possible. They haven't reported yet, but everybody's expecting $1 billion loss in Q4 of last year for this credit card alone. That is crazy, guys. That is insane for something like that. But you know, it is what it is, and I think Apple has the cash right now to fix this. But they got to work that out with Goldman Sachs. I don't like it. I'm watching the situation. I'm going to continue to watch the situation, and we're going to continue to see what happens with that, because to me, it's an indicator, and I'm watching it to see if this is going to fall or not.
The Goldman Sachs reports on Tuesday. I wonder if they'll comment on it.
They may. I mean, they commented in the two articles I read today about it. So I mean, but it was just one line comments, nothing in detail like what we would like, because Goldman Sachs has a lot more going on than just the Apple credit card. Brandon, what do you have, man? Go ahead.
All right, so let's start here. Just the fact that 61% of economists polled by the Wall Street Journal are saying that we're going to have a recession this year in the next 12 months. This is a historically high percentage of economists saying that we're going to be in a recession when we're not already in one. So take that as you will. You know, are we expecting a recession that's not going to come? I honestly think it will. Let's look at the CPI real quick, because this also interested me, as it was in the same poll. Inflation eased from 9.1% from last June to 6.5% in December. Now, economists expect it to fall to 3.1% by the end of this year. That's a large drop in inflation growth. And they're expecting 2.4% ending 2024. So that might sound like it's a good thing, but you have to think about like what has to happen to bring inflation down that quickly to those levels. And it would have to be a recession. I think it's actually like, you say, oh, 3% inflation, that's awesome by the end of this year. That's great. But when you think about the steps we have to take to get there, not so much.
Well, and here's another thing. So a lot of people we get a large chunk of our listeners who are brand new to investing and brand new to stocks. And I like to explain some things more, and maybe they can explain it to their friends after they hear from us. But when Brandon's talking about like inflation is going to drop back down to 2%, that doesn't mean egg prices are going to come down. Egg prices are going to stay at where they're at. All right. They're not going to lower egg prices. They're just they're going to start going back up every year at a normal rate. So it's going to take you a number of years to get back to where you were as far as your income versus your outbound, if you will, on your household budgets. It's going to take a number of years to get back to where we were pre this high inflation.
Purchasing power has been greatly reduced.
Yeah, it's going to stay greatly reduced is my point. And we're not going to see it back there for years. Even if we tackle inflation this year, it's going to take, 3 years at least to get purchasing power back to where it was.
Oh, for sure. Yeah. And who knows if it even be then. But last week, earnings kicked off. JP Morgan Chase CEO Jamie Dimon, speaking of the potential recession, he warned of economic uncertainty. even as consumers continue to spend and businesses remain healthy. We still do not know the ultimate effect of the headwinds coming from geopolitical tensions, including the war in Ukraine, the vulnerable state of energy and food supplies, persistent inflation that is eroding purchasing power and has pushed interest rates higher, and the unprecedented quantitative tightening, Dimon said. And then he said, "We do not know the future." For a guy that's as intelligent of Jamie Dimon, excuse me, to say we do not know the future, a guy that is continuously on a day-to-day basis studying the economy and trying to figure out where we're going to go, to say he doesn't know, it's kind of rattling a little bit. The uncertainties are real, and we hope they go away, but they may not. Go ahead, Dave.
Yeah, I mean, so I agree with your point that, like, Jamie Dimon is one of these people that are meant to be, ahead of the game, part of the inside group of people that kind of know which way the world is heading, or the U.S. at very least is heading. And for him to come out public and say, I have no idea where we're going to go. I like that he listed a lot of those headwinds, because a lot of people don't want to list all those headwinds that he listed. And it is something to look forward to. And I think inflation is going to remain. I can't see him dropping to 2%, because we have a budget deadline coming up on Thursday, and Congress is going to pass more money than what they need. Yep. And thus inflation is going to stay higher because of that. It doesn't matter which group's in power. This is what happens every time. This is why I'm a big proponent of pay-as-you-go for the economy from a strictly economic standpoint, not political, economic. Pay-as-you-go is where we need to get back to. But however, saying all that, inflation, I can't see where it's going to drop down to 2% this year. No, I can't see that. If it does, great. But like you said, that means that we're going to have a hard, heavy recession to get there.
Yeah, for sure. Yeah, especially with the government spending the way that they're spending. And, you're just talking about that. Like, anytime you spend something that on something that you can't pay for, it's inflationary. If you're not paying for it, it's inflationary. Inflation is the result of society wanting things that they can't pay for. That's what it is. All right. So Wells Fargo also reported earnings, and I think it was an interesting earnings report, just because they're one of the largest home lenders in America, and they're actually reducing the size of their home mortgage business, and their consumer banking and lending increased actually 4%, and banking loans actually climbed 18%. So I don't know what that has to say, other than maybe persistent inflation. I don't know. That was kind of conflicting information there. And both Goldman Sachs, and let's not forget, we were talking about JP Morgan there. They're both laying off large percentage of their workforce. Wells Fargo said that it was a moderate size of their workforce. Goldman Sachs said 8%.
So Wells Fargo had a 50% drop in income, net profit, for 2022. That's not good, bro. And I think it's because they were heavy into the mortgage market, and that's why they're cutting back on that. They were so heavily into it that they needed to trim it, and that's where they're trimming. I mean, with all the big banks right now, you have profits ranging from up 6% to down 50%, which is where Wells Fargo is. And these are the big banks. I'm not talking about your regional. I'm talking about the big banks. And it's outrageous that he had that big of range, because they still are moving as a sector, because on Friday you had JP Morgan up 2.5%, you have Bank of America up 2.5%, Citi at 1.8%, and Wells up 3.5%. And it's the one that's really, hurting the most. And they're still moving as a sector, even though the range of profits is so wide within those that, when these drop as a sector, you might want to go in there and buy those JP Morgans, which had a 6% gain in their net profit. That's one I would be looking at when the whole sector drops. And when the sector goes up, maybe you do a put even right now on Wells Fargo, because this mortgage is going to get this mortgage I don't want to say crisis yet, but the mortgage downturn that's happening right now is going to get deeper. Wells Fargo is going to lose more money because they were up on Friday. I may even be looking at a put on them come Monday morning, or no, Tuesday morning.
I agree. And that the correlation of their movements is going to break at some point. I think people just were excited about 6.5% inflation for some reason.
Well, I mean, we talked about it in the show, and I said, look, I'm looking for a number under 6%. I said if it goes lower at all, I'll be happy, but under 6% is where I thought that the markets would roar and just completely skyrocket like to the moon. And it didn't skyrocket to the moon because we didn't see that number, but we still saw it's a decent number, but we need more. We need more of a movement. I don't know if we're going to hit 2% this year, though.
Right. Right. So do you want let's go into a little bit what I'm looking for this week, because I don't really have anything in particular that I'm looking to buy at this moment at these levels. I think we've rallied too much too quick. It's an interesting week coming up this week as far as earnings go. And I think this week's going to tell us a lot about the macroeconomic picture. And so, for example, Wednesday, PNC Bank reports. Now, in the previous quarter, their net income increased by 10.2% year over year. What I'm really looking for PNC Bank is I want to know savings rates. How much has savings rate increased or decreased? That's really what I want to see from PNC, just to tell us, the macroeconomic picture. If you're not on the East Coast, just so you know, East Coast PNC is one of the largest regional banks over here.
All right, so you brought up savings rate, right? Savings rate. Yes, I have some stuff on savings rate. Oh, so Jamie Dimon was talking about the savings rate and how there's increased competition for higher rates among other banks. Now, what is he mainly talking about here? Jamie Dimon is mainly talking about, get this, here we go again. I know this is not your favorite company at all, but they are leading the way in innovation yet again, and it's Robinhood with their high interest savings rates. And because of that, Jamie Dimon has come out and made a comment saying now there is increased pressure to raise savings rates among all banks, and we need to act as if this is going to be the new trend. So in 2023, you're going to see savings rates go higher, which means the banks get less of that money. Because it has to come out of their profit, their costs to cover that higher savings rate. And it's all because, yet again, a small startup, Robinhood, is changing the way that these bigger banks are doing things.
Robinhood's always been innovative, and they've always known how to be innovative. They just don't know how to handle money.
Yeah, all right. Yeah, I'll give you that.
Also on Wednesday, Kinder Morgan, they report, and I'm really looking at Kinder Morgan because I want to know what they see as far as oil and energy prices go. As far as Kinder Morgan goes, Permian Highway project entered service in January of 2021. KMI, which is the ticker symbol for Kinder Morgan, they move about 40% of the U.S. natural gas volume. So they'll have a lot to say, I think, about what our energy prices are looking at in the future. And they also move 50% of gas intended for export. So they'll be telling us a lot, I think, about what the continued effect of the war in Ukraine is, and so many other geopolitical issues that we're dealing with today. I think we'll get a little bit more clarity from Kinder Morgan's report.
I would be interested to see what they say about the Ukraine situation there, where they think that's going to end up and how it's going to go, because Russia is coming out a lot recently saying that they are willing to sit down with peace talks. But we all know that Ukraine has come out and said the only peace talks we want is you leave all of our lands. And so, I mean, right now there's no agreement, which I'm not going to get political, but I mean, I don't blame Ukraine for saying that. Just get out of all of our lands.
Yeah.
If I was Ukraine, I would probably say the same thing. However, I'm not Ukraine. Natural gas, based off that situation, there's going to be a big thing because of Nord Stream pipeline. And, they want to see that open back up. They want to see no sabotages in the Nord Stream pipeline, and they want to see it running so that Europe could get natural gas at a lower cost again. Because right now Europe is suffering with extremely high costs of natural gas and oil, and is hurting them horribly.
Now, on the logistics side, on Wednesday, also JB Hunt Transportation, they report, and they're in the transportation logistics industry. Now, freight demand, it's tied to industrial production, it's tied to consumer activity. There's cyclical risks and recession risks, and all this stuff can cause sharp declines in demands for raw materials and finished goods, freights, things like that. So this is the reason why I'm looking at JB Hunt. I want to see what they have to say about the economy and where it's at now and where we're going. Now, as far as this company goes, they're in a highly fragmented, highly competitive industry. I'm not looking to buy them. I just want to hear their commentary.
So I think that a better, if you're going to look at transportation and as far as to give you an indicator of how the overall economy is going to go, I prefer the railroads over like a trucking situation. One of the reasons I'll be looking at JB Hunt would be looking at some of the results from their partnership with Whammo, and to see how that is growing, what their plans are for that part of the that company to grow, to see how many more of those cities and lanes can they expand out to, because the more lanes they have, the more money that JB Hunt's going to make in their partnership with Whammo, because they don't have to pay truck drivers. And now we don't have to deal with truck drivers, and we can just plug it in the computer, send it, boom, truck shows up at the next terminal, and it goes. And there's no more. It gets rid of all these middlemen. It gets rid of the truck drivers. It gets rid of a lot of things that are taking in all this money and cash in the U.S. economy, and it could actually make it even safer. So I would be interested to see how the growth is going with JB Hunt and Whammo. That's where I'll be looking at. But as far as like transportation as a whole, I prefer using the railroads as an indicator and a guide to tell me how the U.S. economy is looking.
Okay, why is that?
The railroads, everybody, JB Hunt, Swift, Schneider, all the big ones, they all go and utilize the railroads. Everybody has to use the railroads. It's the cheapest way to ship things across country, long distances, is railroads. I mean, that's so you really, to me, that shows me a bigger picture instead of just like, okay, JB Hunt is, they only work with like a few of these companies here, this company there. The railroads work with everybody.
That's true.
So it's an overall. It's like looking at the a Russell 100 versus the S&P 500. I get 500 company view here versus 100 company view here, and I get a better overall experience.
Gotcha. That makes sense. On Thursday, Procter & Gamble reports, and here's what I'm looking for with P&G. I want to know what the commentary is on the effects of oil costs. I want to know if consumers are still trading down to private label brands, or if they're actually like trading out completely of P&G products, and if P&G is losing market share. I want to know what they have to say about currency headwinds. And I want to know what they have to say about e-commerce, because surprisingly, for P&G, e-commerce sales increased 11% in FY22, and they represent over $11 billion in sales. This is 14% of Procter & Gamble's revenue is e-commerce. So that surprised me a lot, because when I think of Procter & Gamble, I think that's stuff that you actually go to Kroger or to Walmart to buy.
Yeah, like toothpaste and toilet paper, and nobody thinks of like things you order online.
Yeah. So since the same quarter 1 year ago, revenues slightly increased 1.3%. Growth does not appear to have trickled down to the company's bottom line, and they've had a decline in earnings per share. Yet they're still trading at 26 times earnings. So I'm not touching this company. I do like the company. I like the way that it operates. They do have a 50% gross profit margin. They've got an 18% net margin, which is really high for their sector. But that 26 times earnings, that's too high for me, and it just doesn't make any sense for this company to be trading as high as it is, even after being down, I think, about 4 to 5% over the past 12 months. Still overvalued, and I just, the price doesn't make any sense. So I'm not buying it, but I'm still going to listen to that earnings call again just to hear what they have to say about the overall economy.
Gotcha. And Procter & Gamble is a good gauge of the overall economy, but I'm more interested in their pharmaceutical, because there has been less acquisitions from the likes of P&G, J&J, Merck, Bristol Myers, so on and so forth, of the smaller biopharmaceuticals. So I'm wondering, do we have any innovations coming up, or pipelines drying up? What's going on? I haven't looked at the pharmaceutical industry or sector in a number of years. I used to trade it all the time. So I'm very interested to see where it is right now, what the pipelines are looking like, because I haven't heard much big news. So that makes me concerned. I think COVID was a big push, and everybody was focused there. that all the other projects lost money, and they have been slow to get back up and running.
Well, pharmaceuticals is, it's a staple. So even during a COVID downturn, people still need, their drugs.
Yeah, but I'm talking about the research and development areas in order to produce new and innovative medical solutions for problems. And I think COVID, when it happened, everybody put money into COVID solutions, and it took some of that money out of other solutions. And now we're getting back to a more normal running of these companies, and I'd like to see how their pipeline looks now.
Yeah, and they're still doing it too. It seems like every other month I hear of a new COVID treatment coming out, or somebody's recommending something else for COVID. It's so I think that's still a large focus from the pharmaceuticals company is COVID.
Don't you have like all the antibodies for all the strains, Brandon? You've had COVID like 5 times.
You would think so. Third time was the last time I had it. Was my third time, and they put me on Paxlovid.
I don't even know what that is.
I don't, it's a concoction of like 3 different antibodies or something like that. That's same day, Thursday, Netflix reports. This is actually a company that I'm listening to because I'm thinking about buying, even though they've had a 32% increase in the price of the stock since the last quarter. But some interesting things that I'm looking at here. The fact that they've ditched guidance on net subscriber additions. Instead, they're focusing on financial numbers such as revenue, earnings, and operating margin. And I think there's 2 ways to look at this. They're ditching the subscriber growth, right? So does that mean that it's past its growth phase? Does that mean that it deserves a lower valuation that's more reserved for mature companies? Or can you look at this and say, now we're beyond the add subscribers at all cost phase, and now we're beyond adding subscribers at even the cost of eating up earnings and and margins and all of that. We're beyond that. So now we can focus on profitability, and therefore earnings can go higher.
I don't know, man. I think they can focus. I do like that last statement there. Focus on profitability so the earnings can go higher. Yes, and then they can do that in with not focusing on subscriber base. But the problem is, and here's the problem: they was reported last quarter on their ad base that Netflix had to return some of the money for the ad subscribers because there was not enough people viewing those ads. Because when they sign these agreements, they say, hey, we'll give you 5 million, and if X amount of people don't watch it, then we get 2.5 back. And that's kind of the setup that Netflix had with some of these advertisers, and they had to give some of the money back because not enough people are watching the ads. And I think it's because it's not a big enough savings to make it worthwhile. And so when you're going from like what $15 down to $5, it's a $10 savings. They're like, I'll just pay the $10. I don't have to watch ads, and that's what people are doing. And Netflix is not making as much money as they thought they would. It needs to be a bigger difference in pay, like a $24 a month plan versus a $5 a month plan. Okay, people are going to go with the ad then, because now there's a big difference. But when it's only like a $10 difference, I have HBO Max, and I'll use that example. It's less than $10 difference between the ad and the no ads. So I just pay the difference. So I just have no ads because I don't want to deal with it.
So you hit on it. You hit on the next thing that I want to look at is how is that lower cost ad tiered plan? How is that performing? Because they've introduced that now and it's up and running, and I want to know how it's doing. Right now, an annual poll of major ad buyers, 50 of them, and this was from market researcher Cohen. They found that 41% expect that their largest clients to advertise on Netflix. So that seems good, but what you just said, that's kind of, counter to that. So we'll see how that's panning out. Now, I do think that they have one big advantage. They're not held back by costly mergers and acquisitions like their peers. They have strong original content here, so they don't have to buy content from everybody else like, the Peacock app has been doing. Comcast, they've bought content from other people. There's been bidding wars for shows like Friends and Seinfeld and all of that. So Netflix doesn't really have to, do that. They do have like Seinfeld and stuff like that on there, but they've got such strong original content that they don't have to pay up for South Park, like Peacock did, for example. Now, One interesting thing that came out over the past week that caught me off guard. One of the interested parties in buying WWE is Netflix.
Nice, nice. And you told me about this, and I thought at the time that would be a great fit for Netflix. But doesn't WWE already have an agreement with another company?
They've got it with Peacock, but I mean, if Netflix buys it, then
Do they get all the old content and Peacock can't stream it?
One of the things.
I want to see the contracts. I want to see the contracts to see if this is worthwhile.
So one of the things that people don't know is that WWE was actually a pioneer in streaming. Netflix was already around, sure, Hulu was already around and all that, but as far as niche branded streaming services go, there was nothing else other than WWE. The WWE app solely dedicated to professional wrestling and their WWE content. They've got so much of it. Going back, 50 to 60, 75 even years, they've got content like you could spend your entire life watching all of the content that WWE has put out and probably still not get through all of it. So the WWE network was very, very, very innovative for its time back in, I think, 2012. And then WWE signed that contract with Peacock and put all of the network stuff on the Peacock app. So I don't know. I don't know what happens to that. I'm sure that they would migrate all of the WWE content to Netflix.
We will have to see how that plays out, but yeah, I think they're going to be bought up, but they've already gapped up. The price is already gapped up. I'm not a buyer. Yeah, I wouldn't buy it, but I am interested to see how this plays out, because if Netflix buys it up, that actually might help Netflix in their subscriber base and help it grow a little.
But once again, it depends on how much they pay. I mean, because the stock prices came up so much, and they'll probably have to pay more per share than what the stock price is right now to get a deal done. So
no, you don't have to. That could just be people driving it up. It's like, all right, so when GameStop went up to $400 a share, are you going to say, oh, if you wanted to buy GameStop, you got to pay $500? No, you're still going to pay 10 or 5.
No, but how are shareholders going to approve a deal if they're going to lose money on it?
They're not losing money. They made a lot of money the past week, so they wouldn't be losing money. It's gone up. They are profitable. If I was them, honestly, I would sell. I would take my profit. So. I would take my profit and I would sell right now because they made a good amount of money. Yeah.
I would get out right now too. But if you're a shareholder that just bought in like the past 2 days, I mean, granted, that's probably mostly retail investors that won't have, that many voting rights, but still.
Yeah, I don't know, man. I'm interested to see how that plays out.
And I think the Saudis were going to buy it for $105 a share, but that was just a rumor.
They were. The Saudis are buying a lot more sports entertainment and moving things over there to the Middle East, like the upcoming heavyweight unification bout. All the heavyweight titles of the world, the major ones for boxing, are going to be put on the line in the Tyson Fury versus Alexander Usyk fight coming up in March. I'm going to be watching. I'm a big boxing fan. I will be watching it, but the thing is, I'll be watching at 11 a.m. in the morning on Saturday because it's going to be in Saudi Arabia.
They're going to take America from us. Man, Budweiser is already owned by a Brazilian company. I can't take it anymore.
I know. It's not an American beer company anymore.
Wrestling. They take our wrestling. They take our culture, Dave.
All right, Brandon, what else you got, man?
That's everything.
All right, cool. I'm not gonna. I had something more, but you know what? I'm just gonna take it to this point, and I'm gonna go into final thoughts. Final thoughts, Brandon. You always go first. Go ahead.
Just keep an eye out for those things that we were talking about in as far as the earnings go. I didn't mention what the expected earnings per share was or revenue was. We've talked about that a lot in the past during earnings. And I think it kind of gets kind of boring when I'm just rattling off numbers. And besides, all you have to do is Google it. So if you want to know what Procter and Gamble's expected top line is, you just Google what their expected top line is.
There you go. All right, guys, here's what I'm looking at. First of all, Bitcoin did a 6.5% jump in price. They're over $22,000 of Bitcoin again, and it made all the Bitcoin related stocks jump up. Am I jumping on the ship? No. Why? Because the economy is going to go lower. And so I don't want you guys, if you're listening to the show, to chase the dragon and jump on and try to make money on this going up, because you already missed the 6.5% jump. But it's going to come back down. And if you are a long-term investor in Bitcoin, which I think that's the only way to play Bitcoin right now, I would wait for it to come back down before you jump in. Don't chase the dragon on this. That's a warning out there to you guys. Tesla's still not moving where I want it to move, so that's all I'm gonna say on that. I'm very frustrated with that company as far as this stock price. But there are a lot of good opportunities out there. Listen to some of the things we said. There was a put. I said, I would do a put on that on Tuesday on Wells Fargo. I mean, there's other things to look at here in the economy and things coming up to play off of. Use that, study, take the economic calendar. It's on Fidelity. You can find it for free, and they could tell you what's coming up on the next week. Just do your research, guys. Do your research. Let's make a ton of money this year. I think, Brandon, you called last year. Here's what I'm going to say this year. I think we're going to have a mixed bag. You're going to have 50% of people make money, 50% of people not make money. And the difference is the people who are buying when it's low versus the people who buy after something's already gapped up and taking the move. That's going to be the difference of this year for the retail traders I'm talking about. Are you patient and buying and holding, or are you buying after it's already 10 the move? Because then you're probably going to lose.
Hulk Hogan's theme song is not "I am a real Saudi Arabian."
Anyways, on that note, as always, we hope we've been entertaining, educational, and uplifting, because we want everyone to make money. Have a good night.
Have a good night.